Andrew, it's a pleasure to have you here on Real Vision for the first time. It's always a pleasure to have folks on from the Block Research. I'm a great admirer of the research that you do, the reports that you guys produce. We're talking about a very interesting topic here today, Layer 1 solutions. First of all, for people who may not know what that means, let's start off with a definition. What are Layer 1 solutions and why are they significant?
Yeah, I would define it as, I guess, a general purpose platform. So if you look at, the crypto landscape, you kind of have Bitcoin, which is kind of, optimized for this payment store of value kind of use case. And then you have Ethereum, which, started in like 2015. And it's optimized for customizability, right? So that you can pretty much leverage this decentralized network to do all kinds of different things, whether it be lending and borrowing or exchange, or, as we've recently seen, NFTs. And I guess the reason that it's important is because this is kind of like the next evolution of what you'd call like Web3 is probably a term that's thrown around more than it should be. But it's this next version or vision for the internet, where people can interact and exchange value on a peer-to-peer basis with no real intermediary by kind of leveraging a distributed base of computers, if you will.
Yeah, so Layer 1 solutions, Layer 1 platforms, they really are the base layer of crypto protocols. You mentioned Bitcoin, you mentioned Ethereum. Give us a sense of what some of the other Layer 1 protocols that you explore in this report are.
Sure, yeah. So in this report, we do kind of, I wouldn't call it a deep dive, but we kind of put 7 different protocols through what I'd call like a framework for analysis. So we looked at Algorand, Avalanche, Binance Smart Chain, Cosmos, Ethereum, and Ethereum 2, which we'll get into that later, kind of what's going on there. Polkadot and Solana, and I hope I didn't miss any. But yeah, so there's plenty of different folks out there that are doing plenty of different things. A lot of really smart people working on, what I'd consider to be like a very difficult, computer science and engineering problem, right? Where it's like, how do you like bootstrap growth of one of these ecosystems, and then how do you pretty much get everyone to agree on a lot of things quickly and have it be very decentralized? And that's kind of the centerpiece of it, is that decentralization piece. And if you read through the report, we kind of take, a couple different approaches at trying to not only like describe decentralization and why it's important, but also to try and quantify it. So if you look at some of the marketing materials of all these Layer 1s, they'll kind of throw around the word decentralization a lot. But there's a bunch of different meanings to it, whether it be like a big community where you have a lot of people developing applications, or if you want to get, a little bit deeper into the weeds and kind of start talking about, well, how is the token distributed and how is the validator set kind of, constructed, and who holds what tokens and who holds influence in the network, if you will.
Well, you actually open this report with what's sometimes called the trilemma, this balance between scalability, decentralization, and security. Give us a little bit of a sense of what those 3 points are and why they're so significant with regard to Layer 1 protocols.
Sure. Yeah. I mean, this has been a question that's been, I think Vitalik coined the term the trilemma, and it's kind of been all over the place for the past couple of years, and they're all kind of intertwined, right? So maybe if we start with decentralization, kind of the idea that no one entity can at any point in time kind of come in, and whether it be Bitcoin or Ethereum, and go to, a person or a group of people and say, hey, like, we're here to shut down this network, whether it be a regulator or any type of entity, or even just a corporation that for whatever reason doesn't like Ethereum, right? And how you achieve that decentralization is by having, in these proof of stake networks, large bases of validators who are pretty much running that blockchain software and hardware, and that are pretty much like voting on what transactions are valid, pretty much. And that's kind of where security comes in as the next point, right? So the more decentralized your network is, and the more distributed that base of tokens and people that are pretty much participating in verifying transactions on the network are, the more secure your protocol is, right? And then you can kind of look at it over like a couple of different layers. So the most simplistic way to kind of think about it is like how much value is staked on the network, right? So if you look at Ethereum, they're kind of moving to ETH2, and I don't know what the number is right now. It's, call it, like $20, $30 billion worth of ETH tokens that are pretty much people have staked to secure that network. So anyone who is looking to would look to, corrupt the network, whether that be to just pause it or to, rearrange transactions that recently happened, you need to get, 33% at least of that stake on the network to do so. So that's kind of where security comes in. And then scalability is the one that's talked about a lot. So in the report, we kind of went through and talked about the most frequent, the most popular way that folks talk about scalability is transactions per second. And that's just, over 1 second, how many different transactions can you put through the network at any given time? And where that comes into play is pretty much like, if you look at the user experience, you can look at the data on all these chains and pretty much see when they are coming up against their scalability challenges. So if you look at Ethereum, we had a chart in the report where we showed somewhere that according to Coinmetrics, the daily fee on Ethereum 1 was like $68 a transaction. So people had to pay about $70 to get a transaction through. And that's just one type of transaction. Like there's people are doing all kinds of different things on these platforms, whether it be, exchanging assets or what have you. So some of those have gone up to, in the hundreds of dollars, to whether it be mint an NFT or to do a trade on some sort of decentralized trading platform. So I think it's a interesting way to frame it. But I think as we keep going forward, you're going to see a lot of folks that are kind of positioning on one end or the other. And it still remains to be seen whether, is that still, that was something that was proposed in 2015, right? The scalability trilemma. So is that still, the appropriate framework for analyzing these platforms? I don't know, to be quite frank.
Yeah. We talked about the trilemma while we're talking about 50-cent words here. Let's talk about the taxonomy, which is really just a fancy way of saying the buckets you carve things into. You have a really interesting image on, it looks like the bottom of page 4 in the introduction of the report that breaks down these investable assets into a series of different categories. Can you speak to those high-level categories and explain why they're important for understanding this ecosystem?
Yeah, sure. So, in that image on page 4, we kind of outline the investable crypto landscape. And these are a couple of buckets that our friends over at Masari kind of came up with. So on the far left, we have currencies, smart contract platforms, which are, the topic of the report that we wrote. And then you have a couple other buckets. So we put in here equities and just, some miscellaneous assets, whether it be like a Web3 type token, and then decentralized finance assets, which have gotten a lot of attention lately. And I guess the biggest takeaway, and what I learned when I was putting this together, was well, why don't we just look and see how much money is in each of these different buckets? And if you look at this diagram, I don't know what Bitcoin was trading at the time, but currencies at 750 billion. I'd say Bitcoin probably accounted for 80% of that at that time. So after Bitcoin, these platforms are really in terms of what you can go out and buy if you're a retail investor, probably the biggest option out there. And to date, there's very little what I would call digestible objective research to kind of get into the weeds as to how these assets work, what they're used for, and all that good stuff.
Well, talking of taxonomies, there's another breakdown. It looks like on the top of page 16 of the report, where you're doing this introduction to the smart contract platforms that really breaks down, I think, in a very interesting way, a series of different layers for how you think about these protocols.
Sure. Yeah. I mean, this one, this is a tricky one, right? With each passing year, I think it becomes harder and harder to kind of jam any of these protocols into one category or another. So if you look on the left side, we kind of went with kind of just talking about what each different, without getting into the weeds as to what they all mean, kind of what they're doing. And at that base layer with these platforms, which were the topic of the report, is really where that security and consensus come in. So that's where, the validator set rests. And that's how these networks pretty much prevent bad things from happening, right? So how do you prevent one person from taking control of the network? That's where that happens. And if you go up one more level is kind of where you have your layer 2 scaling solution. So there's been a lot of discourse about these all over the place about, Arbitrum, Optimism launching, and their goal is mainly to for these platforms that have come across some challenges with the scalability, their pretty much purpose is to offload the actual execution of those transactions onto a different platform while still leveraging that security that base layer provides. There's a ton to unpack with all of those. We do a little bit in the report. But so that's what's going on there. And then if you come up one more layer, this is what I call the accessibility layer. And this is kind of where you have companies and decentralized protocols that are pretty much giving every person out there, a way to interact with the platform. So if you look at this graphic, for instance, like Uniswap, they were the team that built this decentralized exchange that if you're a user, you have a certain asset, you want to swap it out for another one, you don't have the expertise to do it directly through Ethereum, right? So they built this product where you can pretty much go in and tap into the decentralized network, whether it be Ethereum or any of the other ones, and kind of do what you want to do there. And then at the top layer, we have all the assets, and we kind of bucket them into a couple different things. We have native tokens, which I guess are the most important piece of the puzzle for this. These are what are actually staked on the networks, and how they get their security. And then you have all these other different assets that can be issued on top of them. So stable coins, which are pegged to the US dollar. And then you have, these NFTs, which have obviously been proliferating all over the place with all these celebrities adopting them. So yeah, it's kind of all one thing that works together, right? And it all comes back to the base layer. When you talk about any of these kind of things, like how secure is your lending protocol or your exchange protocol, and what's its performance going to look like, it's going to depend on what layer 1 and layer 2 solution that you're using.
Hey, if you like this clip, be sure to check out the full interview and more only on realvision.com/crypto. It's 100% free. Sign up now.